Welcome to this explainer on escaping the public market trap. You feel like you're working twice as hard lately, but you're getting absolutely nowhere. Every single time you open up that trading app, nothing really changes. Your net worth just remains completely stuck in neutral. You see the market rally and get filled with hope, only to watch it violently crash and drag you right back down to zero. A vicious cycle that leaves working professionals utterly exhausted and completely trapped.
The real problem here isn't your baseline intelligence. It's just the flawed way you learn to invest. Retail investors obsessively check their portfolios during every single dip. You desperately try to convince yourself that buying index funds works. But the bitter truth is that this obsessive doom-scrolling behavior keeps you permanently trapped, helplessly watching your hard-earned money evaporate while you unknowingly gamble instead of actually building generational wealth.
Holding 85% of your net worth in equities is honestly dangerous. Most people think they're perfectly diversified by doing exactly this. But it's absolutely not true diversification at all. It's really just finding slightly different ways to lose your money simultaneously. You might feel like an absolute genius during roaring bull markets, but a string of highly concentrated tech positions can easily shed 32% of their overall value in just a few short months. True wealth absolutely requires protecting what you already own first.
So you desperately need a radical shift in your mindset. Everybody else rushes out to blindly buy index funds, but the ultra-wealthy are doing something entirely different. While average investors obsess over picking winning stocks, the ultra-wealthy focus purely on building a boring, rock-solid asset allocation foundation that makes them completely immune to screaming financial news and volatile market crashes. They already hold alternative assets that generate some serious cash.
Rakesh Jhunjhunwala famously argued that allocation drives 60% of your returns. And look, this isn't just some catchy financial platitude. It's pure, undeniable mathematical reality. The ultra-wealthy are entirely willing to do the boring, unglamorous work of proper allocation first, deeply fortifying their portfolios before they ever put another single dollar into the notoriously volatile stock market. So, let's break down the exact 5 principles they use to do this.
Principle 1 is private equity real estate. The wealthy invest in premium commercial properties located within rapidly expanding infrastructure corridors. They definitely don't buy standard suburban residential homes for typical consumption. Instead, they target highly constrained micromarkets like Gurugram, Mumbai, and Bengaluru. These deeply strategic areas are experiencing a massive 11 to 13% in annual growth, making them a powerful, long-term store of immense, untouchable wealth for the top 1%.
We're talking about targeted returns of 14% to 20% here. Institutional participation is rising incredibly fast in these specific sectors. The wealthy pour their capital into massive apartment complexes and industrial properties. These strategic private equity real estate plays deliver powerful cash flow, strong appreciation, and incredible tax benefits that most retail investors simply never realize exist, far outside the strict boundaries of volatile public markets.
Principle 2 is private equity. This represents the direct ownership of exclusive, highly profitable private companies. It brilliantly captures gate-kept growth completely outside the open public markets. The ultra-wealthy treat private equity as a mandatory core allocation. They aren't just buying standard shares in massive public corporations to slowly build wealth, but instead, they're strategically acquiring entire professional sports teams, taking heavy stakes in venture capital firms, or even buying private energy companies outright.
Getting your alternative asset allocation right creates massive compound growth. Historical multi-asset rotation strategies yield around 26% annually. At that highly accelerated rate, your money literally doubles roughly every 33 months. This undeniable mathematical reality proves that getting access to private growth is exactly how generational fortunes are rapidly multiplied behind closed corporate doors, while the general public is left hopelessly fighting over the leftover breadcrumbs.
Principle 3 is private credit. You essentially act as the private lender to rapidly expanding companies. These specific businesses can't secure traditional bank loans very easily. But your private loan is backed entirely by solid, tangible collateral. You literally become the wealthy bank collecting high interest rather than helplessly begging a traditional bank for a restrictive personal loan. You step in and lend cash at significantly higher rates, viewing this as a massive upgrade to fixed income.
You look at a remarkably steady 9% annual yield, and the default rates on these collateralized loans remain incredibly low, KKR fully expects these alternative investments to hit $24 trillion by 2028,
Private credit delivers very consistent monthly payments grounded in real collateral, serving as a powerful, necessary hedge against those wildly volatile public markets you're currently stuck in. 1.
Principle 4 is gold as an uncorrelated shield. It's strictly utilized because its price movements are completely independent of everything else. Gold is absolutely not a traditional safe haven asset. 1. It's also not meant to be a primary growth engine. 1. When interest rates skyrocket and standard stock prices violently crash, gold simply moves in an entirely different direction, effectively protecting savvy investors from the hidden, dangerous assumptions deeply embedded in all their other investments. 1.
Ray Dalio passionately argues for holding uncorrelated asset classes. 1. Holding 8 to 12 uncorrelated assets reduces your risk by 80%. 1. You can achieve this massive safety net completely effortlessly. 1. By intelligently constructing a diverse collection of assets that never respond the exact same way to violently shifting economic conditions, you completely preserve your mathematical upside while drastically reducing your terrifying downside. 1.
Principle 5 is building predictable reserves. These are strategic allocations directly into cash and boring bonds, designed entirely for wealth preservation. 1. They also provide immense psychological security during extreme market panic. 1. The ultra-wealthy absolutely love holding boring bonds. 1. They know that extreme predictability matters infinitely more than cheap, fleeting excitement when your primary goal is actively preserving the generational wealth you've already worked so painfully hard to build. 1.
Nearly a third of affluent investors utilize these exact reserves. Cash and bonds are ultimate hedges against dangerous market volatility. Neither of these highly predictable assets will ever make you rich. However, they absolutely guarantee that you'll never become hopelessly poor when the global markets inevitably crash around you, wiping out entirely unprepared retail investors who completely ignored the boring fundamentals of wealth protection. This psychological security is literally worth more than any stock.
Previously, you needed massive capital to enter these alternative markets. You also needed elite connections to even see the deals. But platforms like Morgan Stanley now allow your direct participation. Specialized co-investing clubs actually let you start with just $5,000. The extraordinarily wealthy are quietly moving millions into these specific alternative structures right now, successfully building impenetrable financial bases entirely independent of general stock market performance and crazy public media hysteria.
You must stop being a one-trick pony pretending to be diversified. Chasing incredibly volatile stock charts is a guaranteed path to exhaustion. Start intelligently allocating your wealth to protect against your own unpredictable emotions. You need to actively build an impenetrable financial fortress today. Subscribe to our explainers right now so you can finally learn exactly how the people who actually run the world intentionally invest their private capital.
Remember, your true wealth isn't measured by what you make on a green day, but by what you actually keep on a red one.